So, Matt Luciano again. I guess I gave my intro earlier. I've had most recently 10 years at Air Asset Management, life settlement fund, 600 million, and I ran the private credit side with litigation finance and private deals. Okay, so you're the other part of my biography, and that's probably enough for now. On my right, I have Wendell Savins, Arun Kool, and Stephen Charest.
Charest, yeah.
Charest, okay.
Unless you're French Canadian.
Charest. Not today. Okay, why don't you give your biography?
Sure. Hi, Steve Charest. I'm with Enclave Capital, investment bank, broker dealer. Full biography.
Keep it to a minute and a half.
So yeah, in 1990, I left the pharmaceutical industry and went into Wall Street. So I've gone retail, I've gone institutional, ran a research team, I've run a bunch of teams, migrated eventually into investment banking, where for me, having that asymmetrical information was very good. It's all well and good to have a lot of research. People don't pay you for the numbers, they pay you for your opinion. And I found the most value for me was on the private equity side, venture side. Obviously, I do a lot of healthcare, having left that industry. We particularly like med devices, med tech, life science technology, because of the lower hurdle rate than pharma, although, the exceptions are always the rule. Technology, we cover a lot of space, anywhere from AI, cyber, been involved in blockchain. If I had to put a thematic on it, I would say tech enabled, because we've also historically written a lot of research and helped out companies in the renewable space, the bio-based economy, biochemicals. So advanced materials are in there as well. Our theme, it's funny, in dovetailing with the comments before from the energy team, if you haven't read The Bottomless Well by Mike Mills and Peter Huber, do read it. We bought a few cases for clients over the years. There's room at the bottom. There's a lot of efficiencies to be gained. And if the investment theme that we like is investing where there's shortages of things and how to supply that, we need energy. We need it to be cleaner. We need employees to be more productive than ever. Now that we're all working from home and we're all an island of one, we need to be more productive. So we need to learn how to use AI and robots to facilitate that. None of us probably have a team of assistants anymore. Show of hands, right? So these are all smart areas. So robotics falls in there too. On the robotics side, we like where are there shortages? There's shortages in labor, in healthcare, nursing homes. There aren't enough people to lift the patients out of the bed and get them to the dining hall. So we're going to need robots for that. And there's people that are very smart and they're working on that. So we cover a lot of areas. And then the firm is an investment bank. We're the second oldest chaperoning firm. If you're a banker overseas and you want to do banking deals in the States, if you don't want to open an office and have that expense, we're your chaperone. So what that does for us and for the people that we seek funding for is having 18 offices around the world instead of just one. Gives us a lot of leverage in terms of good deal flow. We can cherry pick a lot of deals. We do a lot of diligence. We've applied some algos to that and try to come up with some smart rubric, but it's experience, time, and relationships. And our focus on the venture side is largely with founders that have experience. This is not their first rodeo. In particular, if they have teams that they've worked well together, we see a lot of that in healthcare. And I'll no longer monopolize that time.
That's great. Sure. Good afternoon. I'm Arun Kool with AK Global. We're an outsourced CIO. The background on our side is primarily on the money management side. The last 30 years as a CIO in equities, public markets, hedge funds, long, short. And then about the last 10 years, much more work on the private market side in terms of private equity and venture capital. We're primarily working with family offices and higher net worth individuals in terms of providing strategy, some direct portfolio management, And more recently, a lot of work on diligence, due diligence in terms of managers and across all spaces, so VC, real estate, probably diligence around 700 managers over the last 8 or 10 years from public, private markets, and all segments. So working with the clients to help put portfolios together and do a lot of introductions as well. Today, last, I'd say 2 to 3 years, a little more work on the, I'll call it investment banking light side, just doing direct facilitation of capital to allocators to individuals looking for capital, especially on the VC side.
Wendell Salmons, AMCAP Growth. So we work with VC-backed startups that are looking to raise debt. We are a consulting firm. So we will put together and market their deals to our network of now over 80+ lenders. We run the entire process from data room competence, data room, to doing the small things like getting NDA signed, all the way to having all the lender calls, and then ultimately collecting term sheets. We have a venture debt lawyer that we have on staff that reviews the term sheets and provides their opinion on as to what they think is the market is saying, if the term sheets are indicative of the market. And we work with the clients throughout the life of the loan. I started out of school as consulting publicly traded biotech companies, and then went to business school at Notre Dame, then in investment banking at UBS after the 44 billion of write-downs. So it was a slow time, but I learned how to pitch a lot. Not too many deals were done. It was a quiet time in the markets. And then went to middle market lending, commercial lending, business banking lending, got into venture in 2020, raising a venture debt fund. Then started working with the LPs of that fund and sourcing other venture debt funds for them to invest in, and resulted in AMCAP, where instead of working on behalf of the LPs and family offices, I thought it was a better idea to work with the founders of these companies and to help them source debt capital, which is the less talked about capital source, but it's minimally or non-dilutive, and it's a great capital source for founders that are looking to not only raise money and capital, but also keep the equity that they have.
Okay. From what I heard from all three of panelists here, it seems like they listen to their investors and the management companies quite a bit. Why don't you just tell us a little bit about what the management teams are looking for? Is there anything different going forward, or same as always, just give me money, or the deal terms changing?
Yeah, so look, I mean, funds have to clear some inventory to make room for new deals, right? There's the talk about who's got how much dry powder and why aren't they putting it to work. If the deals were attractive enough, they would put it to work versus what they've got. And and also having gone through a couple of years of crisis and needing to babysit companies, that's been an issue too. So if we get some clearance with lower rates, I think the appetite is certainly there to find opportunities. Part of our job is always to find, who's a good fit for whom. And it starts with the management team. It's the jockey and it's the horse, and how does it fit? Is it timing, size, returns? Where does it fit? So that takes a lot of communication, and communication's been down the last couple of years. I don't know if folks are hiding under their desk. I've done that too. So I think this year is a lot more optimism going into the friction that's keeping these markets down starts to open up.
Yeah, I think the inventory backlog is a good argument. So in the regular industry of the inventory backlog, there's only one way to clear that, which is lower the price and get it off the shelf. So I think the big issue is valuation and pricing. And be honest, I'm not really clear on how some of the valuations are being done on the VC level. Saying the first round is $20 million, that's not a valuation. That's a cost. That's not a valuation in terms of what the return on investment will be. So I think there's still opportunity, but it's got to be at the right price. So I'd sum it up as the management teams are still looking for funding, but I think you gotta come down and clear at the right price. So maybe there's a little more difficulty ahead this year or next year, 25. But if you clear at the right price, I think there's lots of opportunity, lots of capital available.
Wendell, are some of these management teams coachable?
Yeah, I'd say they're coachable, and to kind of the point, I think that, going back 2 years, valuations were obviously growing at a scale that are unmanageable and not realistic. And what I think you're seeing now in the deal that we're now have management teams that are raising according to milestones. And so we want to achieve these milestones before we go to market, as opposed to let's go to market, let's market our milestone that's ahead of us instead of the milestone that we've actually hit. So it's allowing them to anchor their valuation in. We just added these new clients, we just added this new territory, we just brought on this marketing team. And quite frankly, I think a lot of them are doing that with debt because they can't go to the equity side unless they hit those milestones. So, we've been busy, I think other consulting firms have been busy saying, hey, it's no longer bridge capital to get you to now you can kind of look at it as bridge capital, but one, you're fattening your balance sheet so that you're more attractive to VCs, so they're not worried about your runway. And two, it gives you the opportunity to hit a milestone that's 6 months out. So when VCs come and try to, lower the valuation, you can kind of point to specific things that you've done as opposed to specific things that you plan on doing to anchor that valuation.
So I guess the question is that so there used to be a pretty expansive toolkit to do things to help companies get more venture or more liquidity, like there were SPACs, reverse mergers, all types of other you could take companies public in Australia or Canada or in England, and over time they would segue into the US markets, right? And that seems to a lot of that seems to have gone away. And any thoughts on that? And if the market has contracted with the tool sets contracted, what should family offices who get involved, what should they be asking for, like special considerations? Or what are you seeing?
Well, we like a pretty generic term sheet. Multipliers and all that, that's just gonna hurt you in the end, so we don't recommend that. I think that the big word last year was traction, right? Does that resonate with anyone? Show me traction, and this ties in with what some of the older guys that I know have always said, used to be that a seed round was a seed round. Now seed is, I gotta see post-revenue traction, approaching 10 million ARR. That used to be an A, B round, so now it's a seed round. Okay, so, to get caught up in one, just eliminate what you're calling the round. We need capital. This is where we are. And, very important that you've got a game plan for how it's gonna play out. How do you don't use a toolkit like a discounted cash flow for a startup. You could play around with it just as a reference, but when your founders think that their cost of money is the same as a public company, strike one. The thing that folks want to see is, where do you start to get market leverage, right? Where do your margins start to show me the inflection point where my $1 million investment has a very good probability of getting me 10 at this point. So we're trying to, show me where this becomes a financial risk, not an execution risk, not a regulatory risk, not a proof of market concept risk. So, assuming you're post-revenue, you should have a lot of that. How much can we cook it down to? You've got a 6-month window where you're going to have some of these risks, but at this point, this is where the thing takes off, and make a really good case for it. And I think if you can, in a couple of paragraphs, at least to get folks interested that you've thought it through, show me your thought process, rather than, this is what the market metrics are. I use Carta, or wherever you're getting your data. Forget the data. Walk them through how this is how you get from A to B and then to C. And this is where your funding gets us. I think that's, having that conversation is much more important.
Yeah, I think two things. So I think that the direct investment route is definitely very appealing at the family office level. So just being able to go direct. And then I think what we're kind of advocating on both sides is you can't maybe do a traditional discounted cash flow, but you can do an IRR targeting. So on both sides, just work backwards and say, listen, we're looking for IRR of these metrics. Let's say today we're around 25 to 30, given that it's hard to attract capital, and work backwards to how you get to that 30 number for both sides. So even if someone's on the venture capital side, they want to raise capital, you say, well, you want the investor across the table wants to hear a 30, and here's how I get to 30. And if it's a reasonable plan, it doesn't have to be, everything doesn't have to be set in stone, as long as it's a reasonable plan with a reasonable total addressable market. But I think that's where we're at in terms of attracting capital if you're doing early stage capital on the VC side. So that toolkit, and the toolkit, and later on in terms of the manager or the management expertise comes in later stages with either later stage VC or PE. And what we're finding is that the owners are very understanding of the private equity ecosystem in terms of management expertise being available later on down the road, either for exit or partial exit. So that's how we're kind of framing it.
I have another question. That's all.
Can I just,
Yeah, please, ask me.
so I think, one, I think kind of stacks going to the wayside and kind of disappearing a little bit. I think it's shown that, one, not every company should be public. You had these companies and managers who were managing to valuation and not actual growth. And so they were looking to, hey, how can we exit? I kind of equated it to like house flippers. It's like, let me just fix it up, make it pretty, let me market it, and then let me get out and get my exit. So they weren't actually looking and focused on, they weren't focused internally, they focused externally. As far as tools, on the deal that we're looking at right now, I think that lenders and VCs are being way more critical, as they should be, of ARR. A $10 million ARR numbers really actually a $6 million ARR number once you get underneath the hood and see what's actually recurring and what's actually just one-time revenue.
Mm-hmm.
So I think a lot of times in the past, they were taking that number as, okay, that's your ARR. Now, maybe they're using scalpel, they should be using a butcher knife. It's not the real number, and I think you're seeing a lot more of that now. For family offices, the third part, I think, is sorry, Marty didn't tell me to say this, but family offices need to take more time talking to the insiders of these companies. They have these networks, they should use these networks, they should get more intel.
If they're interested.
Let's get interested.
So I think that's where their family offices have kind of piggybacked on other, kind of valuations, like, well, we'll come in as well, because these guys did have more conversations.
I mean, family offices are co-investors typically, so somebody else does the underwriting typically. But so how much of the investment grid at the early stage is locked up now? I mean, you had like these virtual family office networks that were like promoting investing in Eastern European ventures and, put in something, and then those guys are nowhere close to ever going public, right? Maybe they'll be acquired, or angel networks, or what do you call these guys? Crowdfunding, right? All those sources. Like, how much of that do you? So I had a VC come to me. He's probably one of the great VCs on the East Coast, and he's super wealthy, so he doesn't have to worry about raising another fund. He said, "I've done 38% on all my funds, and I'm trying to raise fund 5, and I'm finding just nobody's answering my phone calls." Right? I mean, he did 38% on his last fund, right? Luckily, all of his Bitcoin doubled because he took a lot of compensation on. He's a consulting VC, so he gets a lot of payment in consulting value too. So I mean, and I think that the number of VCs who are not raising new funds is pretty high. So I mean, do you think that ripples through the whole ecosystem, or what are your thoughts on that? I mean, if they're having problems raising money, how easy is it for you to raise money if you have a venture?
I would say maybe 1 out of 10 times if I'm doing cold outreach to a new VC, people move around, right? I had one deal plan where I knew 10 solid corporate VC peoples at the exact right large corporate chemical entities, they all left. 10 out of 10, 10 out of 10, right? So, we do some prospecting, and I would say 1 out of 10 ask if we do capital raise. We have an in-house team that does capital raise. It's a, father and son and 3 associates. You need 100, you're at 85, they can find you the 50, or maybe they can raise you the 50. It's really hard to raise for a 50 million fund. Get 100 million, 200 million fund. That's kind of their sweet spot. So that really lubricates the conversation. Because, I help you, you help me, and all of a sudden our networks are open.
Sure.
That's one. Going back, sorry, repeat the first part of the question.
The question is how much of this ecosystem is locked up right now? Because
Yeah.
nobody's having liquidity events, right?
So, yeah, if you-
Because they all got in it because of FOMO, right? We're paying today, we're paying the price of yesterday's FOMO.
Yeah.
I think that's.
So I think it depends on the sector too, right?
Yeah.
If my interest in healthcare is largely in med tech. So I'm looking for optionality where I've got exit 1, they get bought by another fund. Exit 2, more likely, they get bought by, Danaher, or not Danaher, one of the big med tech companies. Maybe it's Illumina, right? They can afford big multiples, but it's going to be in that ecosystem that they get bought out first, unless they are running as fast as they can and they go public. But we want to see some optionality in that. If it's tech, that's a different story, because they'll probably come, the managers will probably come to us saying, our goal is to go public. Or at least, if not that, then get bought out. They fall into that trick question. So the later stage has to clear, in my book, or at least enough of the B rounds that we have traction in our B rounds and they're maturing. They're getting traction that we need to, either do another round or move them on so we can get the new stuff in. And I think that whole ecosystem is jammed up from the top down.
Right, yeah, I agree definitely. So, and it has to clear, if the average age is around 10 years now for VCs, then you clear that either by you taking back less than $1 on your investment, or taking back slightly less than what you thought you were gonna make as a return. And I definitely agree, it's completely sector specific, and you have such a wide spread in public markets between technology and non-technology on valuations, that it has to flow back to some degree inside private markets, inside VC and private equity. So I think it all has to clear. I think the correlation is higher going forward with public markets, in part because of the backlog and because of the blade fill for the distributions.
Yeah,
I think that's true.
I was just gonna say, I had a business school professor say one time, to your point of your friend is at 38%, right? Past performance is not a predictor of future performance, right? So I think a lot of times you show these historical charts of how well I've done without putting in context that market that you did well at no longer exists.
No, he's legendary.
No, but
It
this is not, this is just like in general, like, you can have past performance, but that's not always gonna be indicative of your future performance. And so what you're paying for is your future performance. So I think, and this is just based on investors that I talked to, like, why aren't you investing? We're trying to figure out what the future performance is gonna be, not your track record. I think a lot of times you're marketing a track record, and what's the true indicator is, what you're looking at going forward. And then I think it's changed in the markets and what is popular now, was not popular 5 years ago, what is they consider to be high growth, and they see to be a longer track. Track is not what it was. It's not what it was then. So I think that's a key issue as to like why people are having issues raising when they historically have it's been easier for them to raise capital.
If liquidity events are harder to come by, does it make more sense to have royalty finance? I mean, is Mr. Wonderful the smartest guy in the world right now, or what?
Good answer for that.
I don't know. I don't know, but
Revenue, right? Why not take a revenue share?
I don't know, but I think the secondary market in theory is the easiest way that already exists to open up the backlog. Again, at the right price, the structure's there, the setup is there, the understanding is there, the returns are there if you can buy them at a discount, at least at the fund level. It's already happening at the PE level where you're buying the secondaries at 90, 85, 88 cents on
It's
the dollar.
so choppy.
It's a lot less than that.
Right, but they're taking the markup immediately, right? So it's already happening. So it's now moving into the VC space. I think that structure scales. So it's probably the easiest way to do it in terms of building scale.
Who here's had a secondary broker call them in the last year or two, or get secondary emails, right? I mean, I get these all nonstop,
Who's your guy that was just here, he does a secondary fund?
that guy, yeah. I don't know.
I'm sorry, I forget your name. No, he's not here, but yeah, no, we had a quick discussion about these, because secondary fund, steep discounts. Because people need to sell 10% of their piece. So getting back to a point you made about the correlations, it's funny because you've got, if you bought the ETF for consumer discretionary, 95% of that or more is Amazon, right? If you're buying the S&P 500, it's NVIDIA and company, right? So we have some skewness in the private markets too. I just saw a graph that somebody had posted, the median Series A in San Francisco or Bay Area is 63 million post, right? Miami, it's 33% less. Atlanta's a little bit less. San Diego's a little bit more. It's a more competitive market. There's bigger deals. So New York and the Bay Area, they tend to have bigger deals. There's more competition for that. The big funds are paying up for that, right? So there's those are the NVIDIAs. Yeah, I mean, they're bunkers, Series A companies, they're trying to make them unicorns. So portfolio selection being what it is, what are the underbanked areas? I'd like to say that I'm interested in underbanked areas because there's more value there. You have to do a little bit more homework, and it's a little bit more of a selective investment pool. But there's a lot of spaces in there where you can find the founders are more than flexible. They wanted to get funding because time is what they're concerned about. We'd rather get the deal done and take a little less.
That's the investment thesis of a private equity firm in LA. They're pretty big, and I forget their names, is that they invest in non-gateway cities, very good universities where you've got great senior management, you just don't have funding. Right? It's very difficult to come out of Oklahoma or
New Zealand,
Texas. Right. What are your thoughts on it?
But also, I think the geography map has changed a lot, right? So COVID has completely changed the geography map where it was pretty much the Silicon Valley and pretty much New York and Boston. And now you see Nashville, you see Raleigh, you see Denver, you see Salt Lake City, you see a bunch of cities that are, obviously Miami, even Tampa, Florida Thunders is based on Tampa. There's a lot of cities that have popped up because people have said, hey, one, California is a mess. I want to get out of here. I'm tired of paying these taxes. Two, with virtual calls, you don't have to constantly living next to a major airport. We have to fly everywhere to do everything. So that map has changed a lot, which I think has also somewhat disrupted and disjointed like the normal raise process, right? You're not used to going to cities that are outside of like the traditional map of where Richard has raised in the past. But I think it's an overall positive thing that you're seeing these cities that weren't considered, tier one BC cities, popping up, and I think it's gonna, in the long run, pay off. And I think the other big point too is just like from an investor standpoint, is just you kind of narrow it down because this is the VC panel, but you can't ignore what's going on globally. So everyone's more concerned about liquidity. If I'm an investor and I know that I'm gonna have to put my money in a fund that's gonna be locked for a long period of time, your return profile might be fantastic, but it's called alternative investing. There's other alternatives that are a lot more liquid, and those look better in times where globally it's a lot more uncertain. So it's going to be tougher to raise when you have a lockup period that used to be 7 years, is now 10 years, and turning to 12 years.
With regards to industry sectors specifics, like AI, robotics, space, and other things, are you guys competing hard against each other to get these deals because the community might want them? I mean, how are you forging, searching and tracking deals that you foresee people may want versus what you think is really good? You happen to have some widget manufacturer.
I think there's competition for deals. However, and this I've seen in the last few years, and I've never seen this, my history is, this is my deal. I'd rather have all of none than half of some. That has changed. I have never in the last 2 years, never seen so many competing banks say, you guys do healthcare. You want a piece of this? I need to get this done to go into the next. All of a sudden, we're cousins. And, so within our firm, one of my jobs, because we're hiring a lot of people, now we're at that mass where we need to coordinate more on our banking deals and cooperate more rather than independent. I got one wing, I'm gonna go off and do my own thing. So it's internal, and then with our chaperoning network, we're getting a lot of deal flow. The folks in Asia can't get deals done, so they're looking for US investors. So there's reciprocation there. Same thing with Switzerland, same thing with the UK. Deals are deals. And people want to get deals done. And so now we take that one, Venn diagram, plus Venn diagram. We're at 2 standard deviations now with cooperation amongst former competing firms, which is great. Why not help each other close more business? So that right there tells you the challenges that we've had in getting things done. The work's been done, the diligence has been done. We've vetted out good founders. They're bleeding. So they say, how much do we have to bleed before we do the down round before our down round? Let's not call it that. Let's just call it getting the deal done. So, but we're seeing a level of cooperation we've never seen.
That same thing is happening in debt.
Agree.
There's all these debt syndicates, and I was told the reason why it says technology is available to make it easier to do. Right, in the old days, somebody used to take down entire portfolios of loans, and now it's all syndicated, and very few people take more than 10%.
Yeah, no, well, if you take the broadly syndicated loan market, which is the larger the public market for small and mid-cap companies, you can see something like that potentially replicating in the private debt ecosystem with funds doing similar syndication across funds. So co-sharing.
And just as an aside, I don't know, is that happening in the revenue finance space?
Merchant cash advance space, absolutely. It does happen.
That's hard to win.
And in the venture debt space, like typically we'll have it at 100 million, they will syndicate. So there's even your larger funds or your BDCs that are publicly traded, and they technically kind of have no real cap on what they can lend. They're still on the syndicate over 100. One, because the underwriters get nervous, so they like to have another look from another underwriter. So it's a good way to kind of not only spread your portfolio risk, your underwriting risk, leverage the knowledge of someone else, especially if it's in an industry that, hey, we were comfortable with them at 50 million. They're now a larger part of our portfolio. We're not a cybersecurity expert shop. Let's go find, we know that Runway's got a great cybersecurity team, or Trinity does. Let's go to them. We know we have a great deal here. We know that they like it. Let's bring them in as a knowledge expert, and we're more than willing to cut up the pie here in order to make sure that we have a good loan through and through. So I think there's a lot more, even over 50 million we've seen where, lenders will come in and they will recommend, it's like, hey, we want to bring in X, Y, and Z, or have you reached out to this fund? They might want to take a look at it. There's certain funds that will say, hey, we don't like this deal, but why don't you call X, Y, and Z? This is a bigger fit for them. They want to see the market grow as well. They want to see deals get done. Whether they can do it or not, it's still good for venture debt to get deals done.
Yeah, and I think the venture debt, if you look at the assets raised, it's very low number. I mean, it's well below 5%. The total assets raised are on the debt side. And to avoid down rounds, the VC side is much more open to debt at 11, 12, 13, 14, 15% to avoid the down round mark. So I think that area grows even at 10 or 12 or 15% in the near term, given the current logjam.
Yeah. So Ira's discussion earlier is indicative that, to your point, where there's a shortage of expertise, this sports gaming section, we haven't even gotten the website updated for that yet. It's moving so fast. There's a handful of people who are really very well versed in it. So, it's, and that's where we've sourced a lot of our deal flow from that.
Oh, interesting, yeah.
Yeah, people are coming in like, well, you've got an attorney running the firm, an attorney running the banking side of the sports. we feel a little bit more comfortable that you're versed in the intricacies and you know all the players.
Well, actually, the sports venture capital space is small.
It's small and deep.
Everybody knows everybody else.
Yeah. And it's international, so it's even,
We got a little more than 5
deeper.
minutes, Matt.
A little more, 5 minutes, okay. You know, besides the US, are there any other countries, and I know like Israel's pretty big in biotech or med devices and things.
Yeah.
Are you guys spending much time? You mentioned it, any panels and deals across the pond?
We're gonna move, we're expanding to Europe as far as venture debt deals, but I think that it's funny that you mentioned Israel. I know of a med tech company that is reorging in the United States because they're having issues raising due to what's happening in Israel, whether one way or another. It's a you know, an obvious risk, and no one comes out and says like that's the reason, but they are de-risked, they are revenue positive, they have a highly experienced CEO that, you know, was at Johnson & Johnson and then Pfizer before that, and they're having issues raising a very small $5 million round. So you're seeing a lot of, you know, a lot of movement, and I think, you know, ex-US too, there's a lot of activity. I know the venture debt market, there's a particular lender who's saying that it's just too hard to get deals in the US. So they're looking to do deals in Australia, they're looking to do deals in Europe, but Australia, for whatever, they've seen the most success because basically it's less competitive, they're being able to cherry pick deals. I'm not too familiar with the names of that market, but that's just one region that we've heard.
yeah. My experience with Israel is that the big change you notice in the conversations is this deal's not good for us right now for a timing reason, but I've got 5 other people I want you to call. I don't get that here. So, you know, we're all in this space. Let's move the ball forward. This seems like a good idea. That's an interesting perspective.
There are more Israel deals flying around than ever before.
Sorry, what?
There are more Israel deals flying around in the ether than ever before.
Yeah. Right. Well, people read Dan Senor's book, so just getting around to
What was the one? Why was it?
Startup Nation.
No, it's not about that at all. It's about trying to get away from risk.
Yeah.
Massive relocation of Israeli manufacturing in the United States right now.
You know, all through the day, we heard a little bit about, you know, AI, right? How do people get comfortable with their data being secure and not just kind of being almost like a malware, stealing data and stuff?
Go ahead. We both nailed at the same time.
I just think at some time it's gotta come back, it has to come back in-house, just in terms of owning the data or the cloud or the server, the security, in terms of not using generic, I'll use the word generic AI in terms of whatever AI is. So I think at some point it has to come back in, has to be customized, it has to be set up to what that firm is looking to do. And your application software tools are the same as the application software tools that we currently use, whether it's CRM or Autodesk or Adobe or whomever. I think it circles back that way, but I don't think that's the common view, but that's how I see it.
Yeah, to your point, I think like actually raising money for a cybersecurity company right now, and one thing that they noted is that I think the 3rd highest employee in tech startups is the cyber expert. And too many times, I think it's always going to be external as far as your cybersecurity, but you need an internal person who can actually speak that language and translate that to investors, translate that to the board, translate that to management. And for too long, there hasn't been a cybersecurity expert in-house. So basically, you're just trusting the cybersecurity company that you've hired and that you just take because they're the cheapest, as opposed to not the best, and you don't really know what they're doing. You just assume that they're doing the right thing at all times. So you see a lot more of them having an in-house person that, and a lot of times it's a direct line to the CEO. They're not doing, you know, they're not kind of nowhere chart. Their meetings are directly with the CEO, especially in tech companies. So I think it will be like external, but to your point, I think internally, there will be like a position where that's gonna be outside the CEO, the CFO, CEO, like they're on the same plane in a hierarchy.
So $75 million was stolen from SIM swapping last year. And 68 million the year before, and 50 million in 2021. So SIM swapping is when somebody calls the phone company and gets them to move your telephone number to their SIM by faking your identity. So a lot of Bitcoin has been stolen that way, something like 30 million of Bitcoin in the last 3 years by people taking their cell phone number from you,
From the SIM card.
from your SIM card, by swap, using your regular fraud and convincing them that they're you.
Right.
And then they get the SIM card, and then they get all of your blockchain stuff downloads to your SIM card.
Yeah, so,
You know,
so how do you, where are the points of contact where you can minimize your exposure? If you're a family office, you're probably, you might be, HIG, and you might be working from home. I'm in a distributed model where everybody works remotely. Our biggest office is our Italian partner moved into an office in New York. So post-COVID, the regulators, our FINRA friends, they expect that there be procedures to minimize your points of exposure. So you do an audit and you audit your system and you go through it, and then you try to, do the simple things first, minimize those points of exposure, make sure that you're protecting your secure data room, because that's everything, right? That's where all the secret sauce is hidden. You've told your clients you've got a secure data room. It is not Google Cloud. It is not, well, in the old days it wasn't Dropbox, but they've improved some. So, you just take those steps, but you have to have process, written supervisory procedures is what we call it. But once those steps are put in place, at least you can point to it and say, we've taken every step we can take. You can point to it and you can assure your clients that you're doing everything you can to protect their data. So yeah, AI, I'm not sure how that ties into the security part.
Well, I was thinking more from the investor perspective, how they know they're getting, looking at a good deal versus something, proprietary that they can monetize and,
Yeah.
keep that money in-house and have value proposition when they invest in a deal, AI deal.
Yeah.
Is kind of where I'm
So we're
driving home. Someone could say AI, what does it mean? How does it?
We're working with a team that these guys come from the blockchain world, and blockchain is good for certain kinds of security inherently, right? I've done a few deals like that before. You strip it all out and you keep the core elements, and you can incorporate AI into that, where the AI knows if there is the slightest deviation from, be it access, if you access, there's a change in your ones and zeros. So they've beta tested it out with Blue Cross Blue Shield, a couple energy companies. They've got some commercial contracts. They're getting traction in that, but they know it's an arms race. They said, this will work for a decade. Then we'll have to, my kids will work on the next round. So, they're getting there, but I think the key for me on those is you have to be able to explain it to the investor, or at least if they've got a go-to subject market expert, because that's getting harder and harder outside of Google Labs, right?
But you're still seeing the deals and you have to differentiate and how do you give value to the investor?
Right,
Okay,
right.
gotta move on to closing statements.
Yeah. Closing statements.
One parting thought that we should think about for 2025.
I think the key metric, this is not I don't think it's overly profound, but when you're on the venture debt side, the first thing that lenders are going to ask is runway. Right, runway, how much runway it used to be, they looked for, if you had 6 months of runway, then 9 months of runway. That number now is like 15 months of runway for them to feel very comfortable. Anything under that, they know they're gonna get pushback from their underwriters internally. And the quote unquote sales guys from the lenders, they're kind of getting tired of kind of getting pushback, so they are saying yes, they're saying no earlier in the process. There's a stat that less than 5.3% of the deals that venture debt lenders see, they actually submit a term sheet to. That's not, it's done, that's not, goes all the way and gets funded, that's just submitting a term sheet. So I expect that number to probably maybe even drop more as they get more selective, so it's, what I would say is the key part of this, which is no surprise, like how much cash do you have, but like that is before they even ask your ARR, before they even ask kind of, your management team, or you say, what's your runway?
Yeah, my thought for this year is you got to be positive. I think you should be agile. I'm always aware that investing groups, there's a herd behavior in retail and institution and in VC. You're always chasing that hot dot. So be agile, be contrarian, don't be promiscuous with term sheets. Pick your spots, don't go into areas you're not comfortable with. Your banker's hopefully doing a good job in trying to find something targeted for your known likes and wants. But I think it behooves everybody to take a fresh look at the landscape and go deal by deal. Back to stock picking.
I'll maybe give a little bit of a different answer or different kind of a different slant on it. So if you go back to 2021, there were four entities or four segments of the market that were very highly correlated. I'll call it a bubble for kind of aggressive growth type stocks, but you had a huge spread between growth and value. Just look at the Russell 1000, the Russell growth against value. You had a huge outperformance from ARK, which is the ARK Innovation ETF, Cathie Wood's ETF, and you had significant VC returns, and you had a pretty significant IPO market. So I think that if you go forward and that if you look at ARK as a proxy for VC or for aggressive growth, the price of sales have been 4 all the way through until about 21. It went to 15 and then went back to 4. So today, I mentioned that because ARK has gone back to 7. So I think you can use ARK as a proxy for how the valuations are going to move inside the VC market and how those markets are tied together, including the backlog, the logjam of 10-year hold, and the IPO market. So I think you can use ARK, its performance, as a rough proxy for what's going to happen as you go through the private markets. And I think with the new administration, if you remove the con at the FTC, you get rid of Gensler at the SEC, and the government just gets out of the way, then there's huge runway, broad, big picture runway for a lot of activity, a lot of deals. The valuations may not be that great for existing investors, but there's a lot of runway for activity, and that should happen next year.
Great, thank you.
Fantastic, great job, guys.